All right, folks, my next guest sees the S&P up 8% over the next year, and the rally may be shifting to different tracks. I want to bring in now Bank of America Securities, the head of U.S. equity and quantitative strategy, Savita Subramanian. And Evita, I just want to start with this chart.
Let's do it.
This is where we are. I mean, this is, the current rally right here. And this is where we've seen rallies go in the past. Like I said at the top, I kind of consider this all to be a secular rally going back to March of 2009.
Yeah.
And the question is, we spend so much time on Wall Street trying to predict when it will end. Sometimes I wonder why we just don't enjoy the ride.
No, it's a great point. And stocks generally go up. I mean, that's the rule of thumb.
Right.
So you should always be invested in some part of the equity market. I think these charts are really important in highlighting the longer-term trend of equities. I mean, I think we could be due for a 5% pullback, but that's not the end of the world. We have pullbacks of a 5% magnitude on average about 3 times a year. So, even though the market might be a little bit softer into year end, I think that could be just a resumption of normalcy.
I mean, a lot of times the last couple of weeks in October hit seasonality, that's dipped, and then we kind of get really into a sort of more strength. Maybe this time around it'd be a little bit more choppy.
I feel like we got our good boost to the S&P in a seasonally weak period.
Right.
So it was a very bizarre, August and September.
Right,
where
September wasn't down, it was up, and
exactly.
it was up nicely.
It was up a lot. But I do think that there's something going on underneath the surface that's kind of interesting. So if you look at this earnings season, we've had more companies beat on earnings and sales than we've seen in years. We've got a very nice breadth of companies posting positive growth. So I think we are in that environment where the market is slowly broadening out from beyond just mega cap tech to other areas.
All right, I want to get to that, more into that, but let's just talk a little bit about the broader, what powers this train over the next year.
Yeah, absolutely.
You've talked about deregulation, reshoring, upgrading capital stock, and Fed support. Let's kind of talk about this here. Upgrading capital stock, what exactly does that mean?
So that means that in the United States, we haven't made stuff for a very long time. The age of equipment in the United States is at record levels of oldness, or I don't know what the word for that is, maturity.
Antiquated.
It's antiquated.
Old,
it's old. Stuff is old and rusty, and just replacing an old piece of equipment with a new state-of-the-art machine is a game changer for efficiency of a lot of companies. So I think just that efficiency story is starting to kick in. It's not all about AI.
Sure.
AI is part of it, but it's also just...
I love that you brought that up because, again, the focus has been on mostly AI and the productivity gains from that. But to your point, if you take the average household, the average car is like 14 years old, right? So,
right.
Yeah,
it's just replacing old stuff. That's half the battle.
So keeping with the train metaphor, the next stop on this AI train broadens out.
Yes.
It's not just the picks and shovels and the Mag 7. You're looking at financials, healthcare, labor-intense consumer companies, and commodities. I want to talk about this labor-intense consumer. Amazon bringing on 600,000 robots. It's great for Amazon's bottom line. At some point, though, can we have a great economy if that many people are losing their jobs?
Well, I worry a little bit about the consumer. And I think your point about broadening capitalism to Main Street is an important one, because so far what we've seen is that consumption has been most aggressive in growth in that white-collar kind of professional services cohort. That's the most job insecure area. So I think that the idea that consumption is just going to continue with the same cast of characters buying things isn't necessarily the right picture. We could see more manufacturing, skilled labor, that area of the market begin to thrive and drive consumption from here. So I think just that subtle change in who's buying the most.
And those would be higher paying jobs as well.
Exactly.
Right.
I think that skilled manufacturing, that's one area of the labor market that is still very, very tight, especially after, immigration tightness. So there are pockets of real, strong wage growth in the United States. It might not be the same areas that we've enjoyed for the last 20 years.
So we've seen the AI trade broaden out and within tech beyond Mag 7 and within the market beyond tech.
Yes.
And the 493, you reference earnings. This is one of your tables, right?
This is our chart,
So this is one of your charts, and it just kind of explains, though, what was forecast and what we actually have seen. Earnings been phenomenal. The dark blue, folks, that's the Mag 7. The They've outperformed. In the meantime, the 493, even with low expectations, have underperformed.
They still get
and we're
revised,
expecting this
yeah.
to sort of turn around.
We are, and we're already seeing it. So that's the good news. It's not like a hope and a prayer at this point. It's in the numbers. But the question is, how much good news is priced into AI? And will there be positive surprises elsewhere? So I think for the tech companies, and this week is a very important week because you've got 5 out of 7 of the Magnificent 7 reporting. And the question is, are we going to see that AI monetization? Are companies going to start making extra sales for all that CapEx they're spending on power? And I think that this is the show me moment where you really want to see that revenue boost rather than just we're going to spend and build, and if we build it, they will come. I don't think we can do that
because
anymore.
it kind of reminds me of that now infamous MIT report where only 5% of these companies were getting any kind of return on investment. But it feels so early to say, hey, we've invested in AI and we want an immediate return on that.
It might be early, but I think the idea that if you're borrowing money to spend on CapEx, that's where it becomes rocky. Right now, most companies can fund their own spending. But if you get to a point where you're not making enough money to match your accelerated spending, that's when you start to see problems. And that's what we're watching.
Speaking of accelerated spending, the hyperscalers, I mean,
Exactly.
how far can you go? This is free cash flow, operating cash flow rather. This is probably the peak right there, But even if it isn't, listen, I mean, even if it is, if it's here, is that an indictment though? I mean, a lot of folks are saying if they won't be able to spend this kind of money, so therefore the party's over.
No, I don't think it's an indictment. As long as their return on capital clears their cost of capital, it's a great strategy. But, that's what we got to see.
I love this when you guys put this out.
This is our big,
60% elevator risk. I'm nervous. So what's missing here, okay? Only a couple of things are missing here. With this sort of checklist, right? 70% of the just shy of 70% average for market peaks. Is this something that how decisive is it in the decision-making process? If we check one more box, do we get out of everything?
I mean, I wish it were that simple, but I think what we're waiting for is sentiment to really improve to those lofty levels. Like, remember back in 2007 or 2000 when everybody was bullish?
Sure.
There were no worriers, and we're not there yet. We're still in this wall of worry type of market where folks talk about what could go wrong. The average allocation that Wall Street is recommending you put into your into stocks in your portfolio, 55%. That's pretty low. I mean, 60% is the benchmark. So I don't think we're at those euphoric levels of bullishness that would mean, you want to sell.
Yeah, back then, of course, it was like every time you got in a cab, everyone was listening, making trades at the red lights. They were going to retire. Everyone was going to buy an island at 40, right? You don't get that. You get in an Uber and they're like, I hope I can make it to the airport in time. So no one's really talking about retirement. I want to talk real quick as we run out of time. Sector overweights. I don't have a problem with any of these materials, though. It has its ups and downs. Healthcare had a nice bounce led by United Health, but it feels like, maybe the biotech sector.
Too soon, Well, look, healthcare is a sector that's pricing in a lot of bad news. What made us really bullish on healthcare was seeing this mass exodus out of the sector. So ownership in healthcare has been obliterated over the last 6 months. And I think, it's priced for a lot of bad stuff to happen. Meanwhile, the bad news is in the stocks. They pay decent dividends. They've got quality balance sheets. I mean,
could you say the same to the same degree with energy?
Energy, same story. Energy is reviled because, for all the reasons. But these companies have capital discipline. They're laser focused on dividends and buybacks. I think that this is a new era for energy companies in terms of discipline.
And I think what we could say for both of those sectors, you got to like the risk reward down here.
Exactly. They're cheap. They're the only cheap sectors.
Love when you're on. Thank you.